All right, welcome to another episode where we're going to review what happened to mortgage rates last week. So, this is the area that we're talking about, starting with these big, ugly red candles and ending with this one over here. Let me just clear this out real quick so we can see the whole picture. All right, so essentially what happened on Monday when we come back, this is October 2nd, is the Fed keeps on talking about rate hikes. And to be honest, everybody's tired of it. So, we've been on this downward trend for quite some time. And really, what ended up happening is the investors are looking at this going, the Fed is going to keep pushing this down. They're destroying the economy. This is a nightmare. That's really what they want. They're trying to reduce inflation, and we are sick of it, so we're selling off. In addition to that, if we come back to this candle right here, where it really broke below, because it kind of went down and tested this area of support, this was the lowest it had been, and then it broke this, and this is where the market just tanked. Right? And this is where we're in a free fall position and there is no bottom. All we have is history now. Okay, so we don't have a lot of strong points of resistance. It just broke through this floor, and honestly, it's pretty scary because you just don't know where it's going to end up. So the jobs report came out, the job openings report, and is basically saying that more job openings happened than they expected. But the problem with this is it double counts jobs, so it is a very flawed measure to look at, but it still showed that there were more job openings. Now, the other funny thing about that, though, is after they kind of digest the news, is that a lot of those jobs are double counted. So the market reacted. Luckily, it went the other direction. It looked as if it was strong, but now this point right here, where it used to be the floor, is now a point of resistance. If we were to throw a line out there, it is right here. Okay? That line right there is now acting as a point of resistance. So it makes it very difficult for pressure to move above it, especially from a technical perspective. It's going to take something fundamentally to push it above. So when we come out throughout this whole week, really what they were looking for is the Friday report, which is the BLS jobs report. And the BLS jobs report said that we had 336,000 job creations in September, which was much stronger than the 170,000 that they anticipated. So of course the market reacted strongly, pushed below this, which was our new low, and it looked as if we were going to have just a free fall. However, as usually happens after these reports are put out there, they digest it. They look at it and they say, wait a minute, there's a lot of conflicting information here. This whole thing's a lot of conflicting information. And some of this is being driven by just weird market sectors, the energy, things like that. But if you actually break this down, you find out that a lot of these openings, a lot of these jobs created were from the government. The private sector is not that healthy. And we're seeing continued smaller data points within all of this noise that's showing that overall your regular jobs, your regular job creations are much lower than what they would expect. So it's actually showing that there is an impact out there, but there's a lot of noise that's covering it up. And if we really look at this, what we find is that part-time workers increased by 151,000. So that means that multiple people are having, they're maybe having jobs, but they're part-time. They're not full-time. And then full-time workers actually fell by 22,000. So multiple job increase holders, so you get your part-time, you get your full-time, and then you have people that have multiple jobs. Well, multiple job holders increased by 123,000, which means that more and more people are having to go and get another job in order to make ends meet. So as it digested this, it said, whoa, wait a minute. And it came back up, and then it kind of hovered around this area. So they basically got to a point where, this is some conflicting information. We have some job openings, but there's other things that are telling us maybe it's, the economy is getting weaker, but the overall picture is the Fed, for whatever reason, still wants to increase rates one more time. So what we really have is kind of a mess. So it pushed down here, it's got a new low, and now it's in a new trading range. And that's where we are. So until we get additional news next week, this happens every week. So as the market continues to develop, then mortgage-backed securities react. Now this line right here is acting as a new point of resistance. These are points of support as you're coming down. Now you have to be able to break up if you can. Then each one of these acts as a separate point of resistance. Meanwhile, our averages continue to come down. So So that is our weekly report on mortgage-backed securities. Not so good for interest rates. They didn't react as strong as I would have thought, but when it came down here, I mean, you are talking about some pretty solid 7% numbers and some into the 8% depending on the credit score. So keep this in mind. This is our new reality. Who knows how long it will last. Until next time.